Hello and welcome to the Killik and Co Market Update. This week, our new Prime Minister Liz Truss has announced a fairly substantial energy support package that will help households and small businesses. A new energy price cap will be set at £2,500, and that compares to the previously expected price cap of just over £3,500. So effectively, the government is giving a subsidy of just over £1,000 per household. The support for households will last for 2 years, and there is also going to be some support for small businesses which will last for 6 months, but we're still waiting for the exact details of what this support for small businesses will be. The total cost of this energy support package will be fairly substantial. The government is effectively picking up the difference between the new price cap of £2,500 and the price in the market. So the cost of the scheme is expected to be in the region of £150 billion. And to put that into context, the total cost of the UK's furlough scheme was £70 billion. While this is certainly good news for individual households, it has led to some concern about the level of UK government debt. Here's a chart showing the debt over the last 20 years, and you can see there have been substantial increases due to the financial crisis and also due to COVID. The pink bars show the absolute level of UK government debt, and you can see that is fast approaching £2.5 trillion. The green bar shows the level of debt as a percentage of our GDP, and you can see that's recently gone over 100%. One potential benefit of this price cap is the impact on inflation. We look at one particular measure of inflation called CPIH, which includes housing costs. On this chart here, going all the way back to 2015, we've got a breakdown of the different housing costs that are contributing to inflation, and the electricity and gas costs are shown by the pink bars, and you can see these have increased hugely over the last few months. This new energy price cap will have the impact of forcing those down, and that will have the effect of bringing down the headline rate of inflation. Also this week, the oil price has dropped below $90 per barrel. Here's a chart showing Brent Crude going all the way back over the course of the last 20 years. And you can see the fall in the price as a result of the financial crisis, again around 2014, 2015, when there were concerns about the Chinese economy slowing down, and then more recently as a result of the COVID crisis. The more recent price fall is resulting from many different reasons, one being renewed concerns about the rate of global growth, but also the G7 countries have agreed to impose a cap on the price of Russian oil. So, as I said, there are many different reasons why the price of oil has come down, but one positive side effect will be that it will have the effect of lowering the headline rate of inflation. And also this week, the latest export numbers from China were worse than expected. There are several different reasons for this. One is that we still have ongoing lockdowns in China. Another is that many consumers around the world are now buying more services and less goods. But a third factor is that many firms around the world are now moving production out of China and back to their home countries in a process known as reshoring. At the moment, many big tech firms such as Apple and Alphabet are moving production out of China and to other countries such as India and Vietnam. At the moment, China accounts for over 32% of the MSCI Emerging Markets Index, as you can see by this pie chart here. But if many more companies start to move their manufacturing to other countries, that number could start to come down fairly quickly. Moving on to have a look at next week, it's looking very quiet on our calendar, and we aren't expecting results out from any Killik & Co covered companies. Thank you very much for listening this week, and we look forward to seeing you again next Friday.